The Standard & Poor's 500 gained 2% on Friday, February 12th, a big and much welcomed surge after losses all week. The big gain was widely attributed to a jump in oil prices. The sudden correlation of stocks and oil prices is remarkable for revealing just how irrational and emotional the stock market can be. The chart shows the relationship between crude oil and stock prices for the last two-year period. What happened to the black line from June 2014 to the end of 2015, as the brown line, representing the price of a barrel of West Texas Intermediate crude, collapsed from $107 to $44. Stocks soared. Any rational person would conclude that when oil prices drop, stocks appreciate. However, something has changed in the way oil prices have affected the stock market lately. In late June 2015, oil prices started another swift descent, tumbling from $60 to less than $40 a barrel in 6 weeks. On August 24, 2015, the stock market experienced a flash crash, and a long-awaited correction of about 11% occurred in a day. Since then, the stock market has declined as oil prices dipped lower. While lower oil prices have always been thought to stimulate the economy, higher oil prices Friday, February 12th was the major reason cited for causing the 2% gain in stocks. Why is the stock market reacting so illogically? Why is there so much more volatility in stock prices? The answer is that the market is more susceptible to emotional swings because its valuation has recovered to a level in line with its historical norm. This chart shows the price-to-earnings ratio of the companies in the S&P 500 going back to 1990. The P/E ratio tells you how much investors are willing to pay for $1 of earnings. Look at how, during the period around the tech bubble at the turn of the millennium, investors were willing to pay nearly $30 a share for every dollar of profit earned by a company in the S&P 500. Such extremes in stock valuations are signs of irrational exuberance. Looking at the valuations placed on stocks over the past 25-year period shows that investors have been willing to pay about $17 for every dollar earned by a company in the S&P 500. That market multiple of 17 is the average valuation placed on stocks by investors in a low inflation environment, like we are currently experiencing. Look at the period highlighted by the dotted circle. Investors went from a market multiple of 12 in the third quarter of 2011 to 18 in the fourth quarter of 2014. Currently, the market P/E ratio is about 16. While it's below the normal market multiple of 17, the higher valuation level makes the stock market more susceptible to emotional or even irrational drops. The expansion of the market multiple is what propelled stock prices over the bull run that accompanied the recovery from the Great Recession. Stock prices enjoyed an uninterrupted 4-year bull run from August 2011 through August 2015. Lots of bad news occurred in that period, but stocks shook it off and climbed higher. When considering this huge long-term bull market and stocks recovering to a more normal valuation level, it makes sense for stocks to pause. No one can predict stock performance. It is reasonable to expect sideways motion with continued volatility in stocks for now. We're here to help you make sense of irrational market behavior and help you avoid being part of it.